Morning. This is Nick Rach with the Earnings Scout, and today I want to go over page 5 of our report that we issued this morning with regards to third quarter 2024 EPS estimate revisions. In this report on this chart, I want to show you that 478 companies in the S&P 500 have now reported their earnings. What we do, we track their second quarter numbers, but to be honest, that's backward looking, and those numbers were priced in months ago. What we measure is their next quarter estimate change. We measure other periods as well, but in this report, we're looking at the company's next quarter guidance that they provide, and then take all the sell-side analyst estimate changes and aggregate those at the sector level. So among these 478 companies that have reported their second quarter earnings, 35% raised their next quarter estimates. 10% maintained them, and 55% lowered their third quarter 2024 EPS estimates. On average, that cut was minus 2.37%. Now, that means overall estimates are falling. As price rises, the estimates are falling. This means the PE multiple is expanding. So we're okay with multiple expansion when the estimate trends are improving. And minus 2.37% by itself means nothing. What you need to do is compare this to prior periods, and let's try to figure out what's going on. So that 2.37% is a little less favorable than last earnings season. During first quarter earnings season, we saw 55% of companies lower their second quarter 2024 estimates on average by minus 1.49%. And you can see the table below, and then we graph this out for the prior 12 quarters, so the last 3 years. And what you can see in here as we look, we had an alligator jaw open in late 2021. What an alligator jaw means to us is when we see the rate of change to earnings expectations weaken over 2 or more quarters. You can see the trend here was weakening in second quarter earnings season. Third quarter 2021 estimates were actually raised by 2.4%. Then they were cut the next earnings season by 2.35. Then they fell by 2.65, all the way down to where the worst of the cuts were occurring when we had third quarter 2021 earnings season. Fourth quarter 22 estimates were cut at a rate of 4.97%. Now, what's significant about that? This was occurring in October 2022. And guess what? That's when this latest bull market started. When the worst of the cuts are occurring, that's usually when the stock market bottoms. As a matter of fact, plus or minus 3 months over the past 35 years, when the worst of the cuts occurs, that has signaled the bottom every single time over the last 35 years. And in 2022, what we had, because estimates were falling at increasing rates and we had an alligator jaw open, the S&P 500 declined 19.44% for the year. But in 2023, the S&P 500 rose 24.23%. Why? Because we got improvement estimates. Now, keep in mind, the estimates are still getting cut, and we can't stress enough, it doesn't matter if estimates are going up or down. It matters if they're getting better or worse. And in 2023, the estimate trends were getting better, or as we should say, less negative. The rate of change was positive. Positive delta means positive stock prices and higher multiples. That's why 2023 was a good year. Now, what we've had here over the past year, we've had a little bit of improvement, a little bit of weakening. We say the expectations have stalled out over the past year. This has expanded the multiple, made stocks pretty expensive. In this earnings season, though, we see the weakening trend again, where the estimates are being cut by 2.37% compared to minus 1.49% 3 months ago. But this is probably what the doctor ordered in terms of meaning this will probably pave the way for Fed rate cuts. It gives the Fed the ability to do that with inflation waning to justify cuts. And when we take a look at those cuts, we're not seeing those fall off a cliff. It's not going from minus 1.49% down to minus 22.37%, which would signal just a collapse in the expectations and impending recession. Instead, when we take the modestly weakening expectations with the expected blended growth rates here, and this chart is actually showing the expected growth for all S&P 500 companies, year-over-year growth, that's forecasted. And if you look through the end of this year, into the first half of 2025, even though estimates have fallen, there is still no recession in sight. So the market right now is perhaps pricing in the most optimistic scenario of what we say the Fed pulling off the hat trick of one, defeating inflation, two, avoiding a recession, and three, dishing out rate cuts. Something we didn't think would be likely, but the market has been pricing this in now for almost 2 years, and it looks like that may occur. But we also don't want to ignore weakening momentum. So, weakening momentum, 25 basis point cuts won't solve that, but the market's anticipating 100 basis points of cuts by year end. So whether that occurs or not, and whether that reignites the growth to start to go back on an improving path, is yet to be seen. We're going to look at the early reporters next month to determine if trends are improving again or if they continue to weaken. If they continue to weaken and price continues to rise, an alligator jaw will open. And when an alligator jaw opens, that almost always has signaled bad things for stock prices. It's predicted every major bear market over the last 35 years, and it's also predicted all but one of the corrections. So, in this scenario, we want you to stay cautious here. And, well, we're going to cross our fingers that expectations trends will improve. So, that's how to read these reports. And this is what the actual facts are of what is going on with earnings. If you have any questions, don't hesitate to reach out to me. Thank you for listening.